Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. I didn't deserve this. Okay, I did not deserve this. Now, we knew coming in, we did a video about it. I told you retail was going to be in the spotlight. I told you about Lowe's and Home Depot. I told you about Target and Walmart. They were going to announce earnings and the market was going to react. Now, I did not expect the entire market to react the way it did today because everything was bad. And in fact, and I'll put this here. This is a heat map. We had talked about what heat maps do and what they mean. Everything was red. This is the S&P 500. And almost everything was red with the exception of TJ Maxx. For whatever reason, TJ Maxx was like the only company, what felt like the only company in the world that was green today. That has to be one of the wildest things I've seen in quite some time. But we need to make some updates. We need to talk about what's going on, why it is going on, and how to really anticipate what's around the corner. So a bunch of interesting things and news and notes that I kind of want to have a discussion around today. Now, y'all know I own Target. Y'all know I own Costco. You know, my wife owns Walmart. So we're somewhat diversified in that sector. But it's interesting. So coming into this season, really, I would even say after the first quarter, and we've done videos about this, there were a few pockets where the market was quote unquote safe, or at least green, that had been at least positive this year. Not many, but a few. And those few were retail, right? Those defensive stocks where you have to go anyway, and we'll talk why some of those are down. But that was one space, so that included Walmart, CVS, Costco, Dollar Tree, Dollar General, and more. TJ Maxx, I guess you can throw in there, but definitely the ones I just mentioned. That was one of the few places that had been green all year up until this week, right? So that was one space. Another space inside of financials were insurance companies. That was one place, and randomly Berkshire Hathaway was one. Utilities was one spot that was green, and then energy. And we know why, energy and oil and all that kind of stuff. Those were just some of the few places that were green. That was it. Everything else was red, and that we've known for a while. Well, so far this week, the retail space is off the board, because now that is joining everything else in the stock market that's pretty red. Now, I'll show you this here as well. So again, this is today's performance. Today, again, this is TJ Maxx is the only thing that did well today, is what it looks like. But if I go to year to date, so the entire year, you can see pretty much what I said. I missed health, but we have talked about healthcare. So you have Berkshire Hathaway, right? You have utilities. You got a few here. But in terms of entire sector, energy, you got some in health, and then utilities, and you got Coca-Cola and a few others here and there. But that was really it. So that was 1, 2, 3 major sectors, and then you had some outliers in different areas. But if I go here to where what was supposed to be a defensive sector, only Kroger is up on the year, and that's it. That's it. And that's not what many people would have expected going into it. That was clearly not what I expected going into it. And it does raise some questions. Was this a buying opportunity? Should you buy some of these low and ride things out? Is this still a defensive sector? Yes or no? And then what do we do now? It really depends on how you want to look at it. So, you know, I have questions, thoughts, and concerns about Amazon. I've brought those up. That is on one of my strenuous review lists to get rid of or to keep for June. That I'm really looking hard at that one because its performance doesn't match other tech companies, and it doesn't match others in the retail space. So as y'all saw, and I'll put this back up again. So like for Amazon, let me go back one. So for Amazon, it's down 35%. Walmart is only down 15. Target is down 30, so it's even doing worse than Target. CVS is only down 8. So, you know, I know they're not 100% equivalent companies because Amazon really does a lot. But even if I compare it to Apple and some of the other tech companies, those aren't down 35% either. So remember, like looking at context, Amazon's doing a lot worse, right? So that's one thing I need to look at. But when it comes to Target and Walmart, these are other things, and we're going to do an entire video of kind of doing a better deep dive comparison between the two. But we need to go back through that process. The process that I talked about earlier, where we spoke about the things that we need to look at when we're consider selling, because that's the exact same thing that I'm going to go through, because I own Target and I need to make some decisions. Walmart right now at this level, being down 15%, given where the entire stock market is, that might not be the worst thing in the world. Walmart's going to be around in the next 10 years, right? If not way longer than that, but I can almost bank on that. Same thing for Target. So the question is, why did it happen? What happened? And do I think this is temporary? And I'll give you my reasons and walk some of this out. So what we do know is that there were two primary reasons that we're reading into from their reports and also from what Walmart said that have hurt these two stocks particularly. And if they're hurting Target and Walmart, you can pretty much copy and paste across the board, because a lot of these companies are in the exact same boat. So for Target, they came out and said, look, inflation is hurting us, and we have not raised prices and cannot raise prices in the way that at least I thought. So for example, I think it was Target, I think it was $100 million more that they're paying in fuel costs and getting things from store to store, from shipping it from the store to your house, and all that kind of stuff. That's higher gas prices, hurting everybody, including Target. So that's expense that you didn't expect. Remember, a lot of these companies run on thin margins. Margins are what I paid for it and what I'm selling it to you for retail. Well, this gap, the gap between here, that's the revenue, that's the profit for these companies. Well, if fuel costs are higher, that margin gets a whole lot smaller, and that doesn't look great on businesses unless they can raise costs. But here's the thing, unless they can raise price or lower costs. But in either case, that margin's getting thinner, that's not great. So the two ways that they can do this is either lower gas prices, which they can't do, they don't control that, but on the opposite side, they can raise prices. But we learned from both Target and Walmart, they have a lot of things on inventory, which means that they have bought and acquired a lot of stuff in the store that they are not selling, and they're not selling it because we're not buying it. We're not buying it because everything else is more expensive. And Walmart came out and said yesterday in some of the summary reports was that their home goods sector, like, people are buying groceries because they have to, right? People are buying groceries, but they're not necessarily buying, the stuff for the yard. They're not buying lawnmowers and all that kind of stuff. And at the home goods stuff, they have, I think it was, I don't know if it was 100 billion, I forget what the number is, don't quote me on the number, but they had a large number in inventory they cannot sell because we are not buying it because everything else is too expensive. And when you have stuff on inventory, you can't move it, you can't sell it, you're spending money on storage. That's less space that you can get other items in, and that's money that you cannot move. That's things you can't sell, which is going to hurt your revenue and your profits. That is happening at both Walmart and Target. It is likely happening at Costco, CVS, and every other retailer. So that is what's going on. So the question is now, is this something that is permanent? Is this going to last forever? And how long will it last? Well, as I say always, I don't have a crystal ball. I don't know how long this is going to last and how harsh how much longer is inflation going to hurt us. We know for a fact that the Federal Reserve is expected to continue to raise interest rates until some point in 2023 at minimum. That we do know. As that starts to continue to kick in, that's going to hurt in some ways. It's definitely going to make things more expensive in some ways, and as opposed to tamp down inflation. The only issue is I don't know how much, if at all, is going to hurt oil or bring down oil costs, because that is tied into what is going on in Russia and Ukraine and a lot of the embargoes and sanctions and all that kind of stuff. So it may do everything to bring down everything else except for oil, which you need oil to produce plastics and containers and a bunch of other things. So that part I haven't quite figured out into how long that is going to last. I know that they're going to continue raising interest rates to slow things down. So some items may go down in price, others may not, but for a completely different reason that the Federal Reserve does not control. So that is a part of it. Am I going to continue holding Target for the very long term? Am I going to switch out in June? I have not made that determination yet. I will likely come closer to a decision once we do our video on Walmart versus Target and really kind of line things up side by side. I think for new investors, really all investors, but especially new investors, I think this is a time to really step back and reassess how you are looking at the market and how long you may have planned to hold things. Target and Walmart are not going out of business. Okay, that I can I can almost guarantee you that. They have been through worse. Walmart specifically has been through worse. This is the second biggest drop for Target in their entire history, which means they have recovered from the same, if not worse, when it comes to a one-day drop. So the question would be, am I okay holding this for, at this point for me, because I'm coming up on a year, am I okay holding this for 2 or 3 years? Notice that I'm not, while I will reevaluate every 6 months, I may need to change my mindset and say, look, we might be going into recession, maybe. Inflation is really hurting margins. Maybe I need to take a step back because I know this particular company is not going bankrupt. People are still shopping at Target, that we know. We see increased foot traffic, so they are growing. It's just the cost of oil, the cost of gas, the cost of their supplies. That is the only thing hurting them. If they can bring this down, this is going to look very good in the future. Can I hold on for this long? Do I want to hold on for this long? Is there anywhere else I can go? Based on what we see, right? Based on what we see on the heat map, there aren't many other places unless I want to go to Kroger, which is the only one that's up. And I don't know when they announce earnings, because it can be one bad day that will erase this entire thing. So that makes it a lot more difficult to say, hey, I'll go to Costco instead. Costco's only better by 6% today, right? Any one day can absolutely change this based on what we've seen in the future. So there is a case, I'm not saying I am, there's more things I need to read into, but there's a case for sitting still. There is a case for sitting still and just saying, look, you have to park this for the long term because there aren't many other places to go, right? Going to cash isn't necessarily the best thing, but because I think we're all confident that Target isn't going anywhere, this might be a buy low moment, but really think 5 years from now, I'm really going to thank myself. 6 years from now, 2 years from now, 3 years from now, I'm going to thank myself for doing this. So we'll see. I will go through and give you my thoughts and opinions on what I will do, and I'll let y'all know when I find out. But that's what's going on right now. Retail is off the board for what we thought and considered. Now there is good news in that Target said that they are looking at starting to raise prices. They haven't pushed the increase price button just yet, so they say in their report. Now, I haven't been inside Target, so I can't verify that for you yet, but they said they haven't really increased prices yet, and that could be something. You still have the holiday season not around the corner, but later this year. You still got outdoor barbecue season, all that kind of stuff. So there is back to school season as well. So there is a case that the latter half of the year could be better. There's a case. I'm not guaranteeing you that. I'm pessimistic at this point. So I'm not going to bank on that either. I'm just saying the case is out there. There's also a case that, again, it dropped by 25%. You know it's not going anywhere. If you know you're going to hold for 2 years, at least a year or longer, yeah, it can make sense, right? It can definitely make sense. So I totally get it. But this is what we know right now. Retail is off the board. While it is still on paper and historically one of the defensive stocks areas, it ain't looking good. And what we have now, and I'll put this back on here, year to date, now that one's scratched off and everything is red with the exception of just one, that brings us really down to energy, healthcare, utilities, and again there are a few in some of these smaller areas. We look at consumer non-durables, there are a few here and there, Kraft Heinz, Coca-Cola, which was up double digits and now it's not. Berkshire Hathaway was up double digits and now it's not. All right, so we're looking at things are condensing, and they're condensing quickly. So just because you saw it last 6 months, year to date, whatever, being really, really high, that can evaporate quickly. So you really want to evaluate your mindset and your goals. It is going to be very difficult if you are looking for really quick gains. I want to get money right now. That's going to be hard. And I've said this before. You might want to start looking for things that you can buy on what we think is a discount, what we think is cheap, and say, which one of these companies will I thank myself for 2 years from now? Which one of these companies can I get today that I'm going to thank myself for 3, 4, 5 years down the line? I think that is the market for what this is. Warren Buffett, he out here buying. We're going to try and do a video this week about what he is buying and what he is getting rid of. People like that are scooping up companies and holding on to them because you are probably not, history has shown us you are not going to find Walmart and a Target at this type of drop for another 30 years based on what we've seen, right? Not since the 1980s have we seen a single day drop in Walmart and Target, and you got them in the same week. They've been here, right? And you're probably not going to get the same you're not going to get the same level of discount and price. Now, it could be cheaper 2 weeks from now, but in terms of dropping like that in 25%, that's going to be hard to find again, at least historically. So we'll see. But that's how I'm approaching it. You really want to shift, and I've been saying this for a while, so you want to shift, look long term, still find quality, and really ride out this storm. Again, Warren is doing it, and the majority of wealthy people are doing the very same thing and finding quality, grabbing what they can for discounts, and really just waiting things out. I don't think this is a quick flip market where you can get in and out real quick and make a whole bunch of money. That is not going to be sustainable in an unpredictable market like this. All right, let me know what you think in the comments below, and I'll talk to y'all tomorrow. All right.